simple basic market structure exercise, isn't it? It's got to have a breaker structure. So when I'm going to be drawing a measured move of any sort, if this is a price here and it bounces here, and then it bounces here, and then it bounces here, when I break south out of here, that's the break of structure I'm looking at there, isn't it? That's the break of structure. The highest high I've had during that period is that price there. So based on that narrative, I'm going to take that measure and I'm going to put it down here, and I'm going to put a guaranteed discount price in place around about that area there. So that's where there's going to be profit taking. I don't know if it's going to be a buy trade, but I know there's going to be a lot of profit taking at that price, allowing me to buy into that profit taking and take a chance on it. So obviously that's exactly what happened. We know there's a lot of selling in here. It's a bottom right-hand hold after all. And we know where the high price is. So when the market breaks structure here, if you know the market break structure here, you just go along to where the market broke structure from. The market broke structure from there, correct? So if the market broke structure from that low, all you've got to do is find the highest high between those 2 points. Yes? All you've got to now do is find the highest high between those 2 points. And that's the highest high between those 2 points. When you make a measure against that, you simply project it to the downside, and that's where your guaranteed discount price is, which corresponds exactly to the $87 bracket level. So obviously $87 is where we're going to find the buy trade. Whether it's a profit take bounce or whether it's a long bounce, we don't really care. We know we've got enough room to take a buy trade. And then worst case scenario, we know that the sell block came in at this price here. We know that that's at $87.45. We've probably got about a $400 to $500 upside on a scalp trade. Now that's a good scalp trade, isn't it? $400, $500 to the upside on a scalp trade is outstandingly good. Did we have any brilliant value on it? Well, let's take a look. The dollar headwinds actually were completely against us on the buy trade. Correct? But on a macro scale basis, you can see the dollar headwinds have been against us at any stage buying. And this is the headwinds tweet that we tweeted out ages ago when we gave you the big short on gold, the big short on oil, didn't we? A while ago we talked about the big short on oil. And this was the big short on oil up here, wasn't it? Well, think about where we've went from and to, guys, during that big short on oil against the dollar headwinds. The dollar headwinds tweet came out around about here, didn't it? You remember that tweet? We told everybody that the dollar headwinds is the reason why we're heavy short selling. Fair value in terms of the spreads. Dollar headwinds were going to stop the price going any higher. And we were selling into the big trade at $93, $92.50. Well, we're trading a low price of $87. We've just done another $5,000 big short trade. So the dollar headwinds on a macro chart basis are incredibly valuable for the sellers. Because if you're trading the oil as far as a dollar valuation, that would put the valuation possibly down as low as $82 a barrel. Now, obviously, it's not just about the dollar headwinds. If we look at the spreads and we ask the question about the spreads, if we look at the background, we can see that the spread seems to be, averaging out around about the $92, $93. $92, $93 seems to be where the spread seems to average out. In other words, the spread's not bullish, but it's not bearish either. The spread is not telling us to buy it or sell it. I know the line's going up, but that's because the short-term pressure's been bullish. The short-term pressure's been bullish. So when we see that narrative coming in there, we obviously understand that. Well, it means that I'm still working on basically both sides of the book here, but still preferring to be short. Still preferring to be short. It doesn't mean I can't come in and play. It doesn't mean I can't come in and start doing some business against some key macro references if I want to, but I just have to be aware of the fact that we've got predominantly a short sell against the dollar headwinds at the moment, the dollar headwinds. Well, this might be some of the argument, Paul, right? I mean, if you think about what they're talking about, everybody from the Saudis to the Russians to the Emirates, everybody knows that the price of oil is priced in dollars, right? So that's the global price of oil is priced in dollars. Everybody knows the dollar is on an upside trajectory because of two reasons. Number one, because of the big ramp up in interest rates, and number two, because of the massive increases obviously we're seeing in the dollar as a hedge product against the falling equity markets. If you're in the oil industry, your biggest risk is that dollar getting stronger, isn't it? Your biggest risk is the dollar getting stronger, because the global energy markets is going to say, well, wait a second. If the dollar's getting stronger, we've got to reduce the price of oil to balance up so that oil in my country is exactly the same price as it was yesterday. But the dollar getting stronger, it's getting more expensive. I don't want the oil. So the Saudis and the Russians basically getting together doesn't, I suppose, surprise anybody, because they're saying, well, wait a second, with a strong dollar, the oil price could be down at $50 or $40 a barrel. Oh, great news. That would be great for all of us, wouldn't it? But anyway, it's not great news for them, since that's their single biggest export. So whilst we might not like it, you can understand that they're not going to be happy at a strong dollar causing the oil price to collapse. I would hardly say that $90 a barrel is the oil price collapsing all the same, but it could collapse the oil, especially if there is a global economy slowdown, especially if China has more lockdowns, especially if China drops off just a little bit in terms of their trajectory themselves. Then of course the demand for oil, not the supply, but the demand might start dropping off. And obviously that's also going to lead to additional oil short selling. And therefore you can understand that these guys are a little bit nervous about that narrative. A little bit nervous about it. You know, obviously you can try and tie it in with the politics, you can try and tie it in with the geopolitical, the conflict zones and various other things. But at the end of the day, it comes down simply to one thing, and that's profits. It comes down to money. It always comes down to money. So we can understand it. We can understand how it's playing out. But it doesn't mean I can't buy oil at bottom edges or sell oil at top edges. But the main one for me just now is this dollar headwind. This is the main one for me. Now, the dollar headwind is bearish, but it's diverging at the lows. And whilst this might have driven down into the lows, it was a guaranteed discount. I know that worst case scenario, I'm going to get a buy side bounce. I got a buy side bounce, and I'm in good shape because it's starting to kick off to the upside. You saw another opportunity to buy some more right there. Do you see it? Another opportunity to buy some more after the dollar started to sell off, coming back into that bullish order block. And you've just taken a 20 up to a high price of 70 for another $500 on the buy trade just there, guys. Another $500. Pretty good, pretty easy, pretty straightforward, pretty sensible. It is pretty straightforward, isn't it?